Picture two neighbors. One is a doctor earning $400,000 a year. The other runs a family business and also brings home $400,000. Same income, same country, same tax rules. But here's the twist. At tax time, the doctor might hand over more than half of that income to Ottawa, while the business owner's family keeps a significant portion for themselves. How is that possible? It's not because one of them is cheating the system or hiding money offshore. It's because they understand something most Canadians don't. Tax isn't just about how much you earn, it's about how you earn it and how you structure it. And that's the big secret behind today's video, how wealthy Canadians legally pay less tax. Because the reality is, most successful families in this country aren't waiting until April to see how much they owe. They're designing their financial lives in a way that bends the rules in their favor without ever breaking them. Hi, I'm Tanya Solsla, investment advisor at CG Wealth Management. I work with Canadians who've done a great job of building wealth, whether through their careers, their businesses, or their investments, but now want to make sure it's structured and protected in the most tax-efficient way possible. And in this video, I'm going to walk you through the exact strategies wealthy Canadians use to legally pay less tax. Things like corporations, trust, income splitting, charitable giving, and smarter retirement withdrawals. And here's the part most people miss. These strategies aren't just for billionaires. If you've built a 7-figure portfolio, if you own a business, or if you're planning for retirement, many of these tools can work for you too. If you find this valuable, don't forget to like this video, comment with your questions, and subscribe for more expert financial content. And if you'd like a second opinion on your plan, you can book a time with me using the link in the description below. Number 1, income splitting through a spousal loan. One of the most effective tools available is the prescribed rate spousal loan. Here's why it matters. If one spouse earns a higher income while the other earns very little, most of the family's investment income ends up taxed at the highest possible rate. A spousal loan changes that. By loaning money at the CRA's prescribed interest rate, currently just 5%, the lower income spouse can invest the funds and report income on their return, where it's taxed at a much lower rate. It's a simple way to shift thousands of dollars of income out of the top bracket every year, while staying completely within CRA rules. Number 2, maximizing corporate structures. For business owners, the corporation is more than just a way to run its company. It's a wealth building engine. Profits left in the company are taxed at far lower rates than personal income. Those funds can then be invested inside the corporation or moved into a holding company for even more flexibility. Over time, some business owners also use corporate-owned life insurance to grow assets tax-sheltered and create a tax-efficient way of passing money to the next generation. What looks like an operating company from the outside is, for many families, also a long-term plan for compounding and preserving wealth. Number 3, using a family trust for flexibility and tax efficiency. Family trusts are another strategy that provide both tax efficiency and asset protection. Instead of holding investments or business shares personally, they can be placed inside a trust. The trust then distributes income among beneficiaries, often adult children in lower tax brackets. This spreads the tax burden more evenly across the family, while still allowing the parents to control the assets. On top of that, the trust can help shield wealth from future risks like lawsuits, creditors, or divorce. It's one of the most versatile structures for families who want to protect and manage wealth across generations. Number 4, strategic charitable giving. Giving to charity can be far more powerful when it's done strategically. Donating cash is the most common approach, but donating appreciated securities is often much smarter. By transferring investments directly to a registered charity, you eliminate the capital gains tax completely and still receive a full donation receipt for the market value. That means more money goes to the cause and less goes to taxes. For families who are already giving, this small adjustment can save tens of thousands of dollars while creating a bigger legacy impact. Number 5, tax-efficient retirement withdrawals. Many Canadians wait till 71 to convert their RRSP into a RIF, only to be hit with large forced withdrawals that push them into the highest tax brackets. A better approach is to start drawing earlier and in a more coordinated way. That might mean taking modest RRSP withdrawals in your 60s. pairing those withdrawals with TFSA and non-registered accounts, planning ahead to reduce the risk of OAS clawbacks, making sure income stays balanced if one spouse passes away. This spreads taxes more evenly across retirement and avoids big spikes that eat away at wealth later on. Number 6, favoring capital gains and dividends over salary. Not all income is taxed equally, and the wealthy pay close attention to the type they receive. Employment income is the least efficient. Every dollar is fully taxable. By contrast, only half of capital gains is taxable, and eligible dividends benefit from special credits. By structuring compensation and investments to lean on capital gains and dividends instead of salary, families can keep significantly more of their wealth compounding over time. Wealthy Canadians don't pay less tax because they've found loopholes. They pay less because they use the tax system differently. They think about structure, timing, and control. They use corporations, trusts, charitable giving, spousal loans, and retirement withdrawal strategies to keep more of their money working for their family and less going to Ottawa. And here's why this matters. If you've built wealth, not taking advantage of these strategies can cost you hundreds of thousands of dollars over your lifetime. Because at the end of the day, it's not just about how much you make, it's about how much you keep and how much you can pass on. If you'd like a second opinion on your own plan, you can book a time with me using the link in the description below.